We've got an earnings alert on Snowflake. The stock is down 22%, but it is off its after-hours lows with the company's call underway. Let's get to Julia Borson, who has been listening in. Julia.
Well, Snowflake's revenue of $384 million did beat expectations by about $10 million, but growth is slowing. And while first quarter product revenue guidance was a range above the consensus, a range of $383 million to $388 million versus the $382 million anticipated, full year product revenue guidance was reportedly below analyst expectations. Jefferies analyst Brent Thill telling us that product revenue growth of 102% year over year fell short of buy-side bogeys, wanting between 105% and 110% growth, with fiscal year 2023 product revenue guidance of 65 to 67%, well short of what the buy side was looking for, closer to 75%. Now, one other key piece of news here, Snowflake announcing that it is buying a company called Streamlit, paying $800 million. That just announced just now on the call. That's a mix of cash and stock. But the company is saying that together, the two companies will help unlock the unrealized potential of data and will make it easier to build applications. Now, on the earnings call just now, Frank Slootman, the company's CEO, saying 1.5 million applications have already been built on Streamlit, saying the company will continue to deepen and broaden its geographic scope with more Snowflake growth coming outside the U.S. Melissa, want to flag the Snowflake shares are now down nearly 23%.
All right. Thank you, Julia. I guess this is a case, really, what is priced in the stock and what the expectations were, because when you're talking about expectations of 75%, more than 100% growth in revenues, Guy, I mean, those numbers are staggering, but not what the stock was priced for.
Thanksgiving 2020, $400 stock. Thanksgiving last year, gobble, gobble, by the way, $400 stock. It's been cut in half. This was a, $160 billion company, still an $80 billion company, trading at probably 35 times revenue. It's still expensive. Now,
40.
With all that said, where can it go? Well, I think it bottomed out around 185, 190-ish a year or so ago. That's probably the level. But make no mistake, even though the stock has been cut in half, again, my opinion, you can throw all the metrics you want at me, it's still an expensive name.
Tim, still expensive?
Yeah, guys, now I actually have it at close to like 42 times. Look, it's a $80 billion company, and they just guided for 23 guide of $2 billion on revenue. So that's really easy math. You have a case here where, workload migrations and certainly departmental migrations and the footprint of this, it's all growing. It's all secular trend, but we got way too out of hand in terms of what we're willing to pay for these companies. And yeah, high margin business. The growth is pretty extraordinary, but I think even buy side whispers were in the mid 90s on these numbers. So significant disappointment. Good for them for going out and buying something with an overinflated currency in terms of their shares. I mean, that's what they should be doing right now.
Guy, I have a question for you. Do you think that the stock here at wherever it is right now is more expensive or less expensive than yesterday?
Good question.
That's a great question. You know, we've played that game with Google the other way, saying on these great quarters, Google's actually cheaper than it was when you walked in. I got to look at the numbers, but just off the back of what I've seen, I actually could make an argument that it's more expensive now. Now, what is it down, Mel? 25%? Think about that for a second. I mean, how outrageous is that? The stock's down considerable amount in the after hours, having sold off since Thanksgiving from $400. It's staggering, some of these moves. And these are not $5 billion companies, as we just pointed out, going into this number at least. It was an $80 billion company. It's interesting to say the least.